Hello folks, this is Jason Urbanek from Oak Partners with a March 2015 Educational Economic Update. In this month's video, we'll talk about some of the major economic events that occurred last month and give you some insight into what they mean for you as an investor. Please stay tuned at the end for a required disclosure statement. The Federal Reserve and interest rates dominated economic headlines last month. To support the economy, the Fed has kept interest rates at historically low levels since 2008. Since bond buying operations ended last October, the next step will be to start slowly raising interest rates to quote unquote normal levels to prevent inflation from getting out of hand. As the March Open Market Committee, Fed Chair Janet Yellen announced that the Fed is moving away from a patient interest rate policy and will start thinking about raising rates this year. Though we don't have an official date yet, many analysts think that rate hikes could come as early as mid-June. Though investors are getting a little bit nervous about higher interest rates, we know that the Fed will move carefully. They don't want to damage the economy. Speaking of the economy, we also get a look at the final fourth quarter GDP, or gross domestic product reading, which showed that the economy cooled in the last 3 months of 2014, growing just 2.2%. This brings overall 2014 economic growth to 2.4%, up 2.2%. In 2013. Investors care about GDP because it's our most comprehensive economic scorecard and shows us at a glance how the economy is doing. Though the relationship isn't simple, healthy economic growth generally translates into strong corporate profits. All else being equal, strong profits usually boost markets. Digging deeper into the data, we see that strong consumer spending, exports, and business investment supported the economy. The growth rate decreases because of higher imports and lower federal government spending. To translate all this into plain English for you, the economy was fundamentally on very stable footing at the end of last year. Though we don't have first quarter GDP numbers yet from 2015, the Fed feels comfortable enough about the economy to think about taking away the training wheels, which means raising interest rates. Looking ahead, as the first quarter ends, investors will turn their attention to corporate earnings reports to find out how U.S. companies performed. Right now, overall expectations are lower because of weak overseas demand, low oil, as you know, and the cold winter. Since leadership teams like to underpromise and overdeliver, we can hope for some positive earnings surprises. We'll know more in the coming weeks. Well, that's it for the March Educational Economic Update. As always, if you have any questions or concerns about what we've discussed, please give our office a call at the number below. Once again, this is Jason Urbanek from Oak Partners signing off for the month of March 2015. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 219-795-1000 and your advisor will be happy to talk to you. Here is the required disclosure. After close, we will believe that information in this report is reliable. We cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for purchase or sale of any security. Please consult your financial planner before making any investment decision. Thank you.